Welcome to your Wealth by Design, a low-stress systemic approach to investing. This is my attempt to build that system. This content is for entertainment and informational purposes only. This is what works for me and may not be appropriate for you. I am not a financial advisor. This is not financial advice. So please do your own research before making decisions with your own money. So today we are up on the day, 0.6, solid single day return. We are continuing our winning streak. Every day we beat the market for as long as that gravy train will keep going. Let's start by looking at the performance on the day. The portfolio returned 0.6 and the S&P returned 0.016, effectively a 39.5x. Anytime the day S&P is flat, it's always nice because it's a small number going to such a big number, but nonetheless, this continues our streak of beating the market every single day since the beginning of the year. How do we do versus the world market? Was down. Wow, international is down more than the S&P 500. QQQ seeing a bump. So it looks like tech is seeing a resurgence. This QQQ result is probably the reason why the S&P hit all-time highs today and then fell back down and was tested. A handful of companies are dragging up the S&P. Everything else seems down. Year to date, we are 6.41% versus 3.05, 1.8, and 3.2. QQQ, man, the most successful ETF of all time. But regardless, we are winning on all accounts. So far, managed money 1, static broad diversification 0. Looking at our portfolio, there's a lot of red across the world today. Most holdings are down. The few that are up are some of our largest holdings, just how we're able to outperform today. Very, very few of our large holdings, I mean none actually. None of our top picks are in the bottom half. So momentum is king right now. Okay, let's take a look at the model. Fear is up, which is interesting considering the S&P was up today. This is an important week for Microsoft, Meta, and Tesla. They all report earnings this week. And we're seeing increased put options on the S&P 500 as a hedge against this rally that we're seeing, which is acting as crash protection against these all-time highs. I mean, as long as, it's like they say, as long as the music is playing, you got to dance. And right now everything's going up. So you stay in the market. We're all benefiting from the rise of the assets, but they're hedging their bets in case it suddenly sees a massive correction. Yeah, it's an interesting day. Everything is going up. People are optimistic, but it just seems too good to be true. Maybe it's the story of the day. So as a result of fear increasing, we have our DCA decreasing, but otherwise the markets are flat to neutral. If we look at, were there any shakeups? Well, I have not updated the model since yesterday, and it looks like gold has supplanted silver for our highest conviction bet based on momentum. Silver's still going strong. Gold and silver save in the portfolio for the most part, but that's the whole point of momentum. The biggest bets need to save your portfolio. That's why we have the most money in them. We'll take a look at our top performers after the recalculation, but just noting what was shaken up. Looks like gold is coming down. Emerging markets are up today. That's your tech boom. That's TSMC. That's South Korea. FTech is up. FTech largest holdings, NVIDIA, Apple, Microsoft, Micron, Broadcom. Tech heavy, obvious why that's up today. Industrial seeing a pop today. Largest holdings are going to be General Electric, Caterpillar, Boeing, Uber. It's a weird one to add there. Deere, Eaton. It's going to be energy and construction. That's it for the shakeup. Let's go ahead and recalculate our weights here. Our top performers show a continuation of the same story. Our small caps international are going to be a double down on all our miners, which are gold, silver, copper, zinc, and industrial equipment. Our emerging markets are going to be TSMC, Samsung, South Korea. Ex-Japan is holding on. This is dominated by a lot of financial firms and Australian heavy industry. EPP actually flat today. Didn't fall tremendously today, didn't rise tremendously today. just gatekeeping in the top 5 here. Let's take a look at our broken trends. We've got consumer staples, real estate, healthcare, and consumer discretionary. Consumer staples and real estate are often considered bond proxies. For consumer discretionary, I'm seeing a report out of the University of Michigan Consumer Sentiment. It looks like there was a miss, indicating a possible slowdown in consumer spending at places like Home Depot, McDonald's, Nike, Starbucks. Amazon is part of that index. Looks like Amazon got caught up in the consumer sentiment rather than the AI updraft. Tesla is a big part of that ETF and is likely seeing hesitation on expected earnings. It looks like healthcare is down for 3 reasons. Wall Street was hoping for a larger increase to the Medicare Advantage payments, and it looks like that's not going to come through. That's going to hurt profitability. Eli Lilly makes up 13% of the healthcare index. We're seeing profit taking in Eli Lilly because of its high valuation. Healthcare is a bond proxy. If interest rates are going to stay high, which for the next few months they are, then their dividend looks less attractive. Compared to the world index, 60% of our portfolio is beating the index. That's coming down a little bit here, but still doing good. VOO, obviously with our increased exposure to things outside the US, we're doing very well compared to the US. And QQQ, right now the S&P 500 is basically just a proxy for the QQQ. It's just tech heavy. Here are the holdings by rank and by percent weight. 12%, 2% in the order. Need the ticker so it's easier to see. Today could be categorized as skeptical optimism. There's caution on the horizon, but a willingness to believe. Thank you for stopping by, and I'll see y'all tomorrow.